Welcome back. A bunch of recent US economic data has led to markets expecting more rate hikes from the Federal Reserve. Last week, the US consumer price inflation and producer price inflation came in higher than expected, as did the retail sales data for January. The CME's FedWatch tool now shows a majority expecting at least 2 more rate hikes from the Fed, March and May, while a respectable 18% see actually 3 more rate hikes, taking the Fed funds rate to 5.75 to 6%. What will this mean for financial markets in general and for smart money? I have with me 2 experts from Standard Chartered Bank, Eric Robertsen, Global Head of Research and Chief Strategist, and Kaushik Rudra, Global Head of Fixed Income Research, with me in the studio. Kaushik and Eric, thank you very much indeed for dropping in at our studio.
Nice to
Okay, Eric, first let me start with you. What's your sense about where the Fed is headed? Are you penciling in 1, 2, 3 hikes?
We have 2 more hikes penciled in for the next 2 meetings. I think it's important to say that the markets were a little bit caught off guard by the strength of the data that we've seen over the last 6 weeks. Really, since the early part of February, we had a much stronger than expected labor report, and then the CPI and PPI reports, which you mentioned. I think what the Fed has been saying all along is that they would expect to keep the policy rate higher for longer. And I think that the economic data recently is playing into their hands a little bit.
Okay. Now, if you're saying 2 rate hikes, what does that do to the 10-year bond? And what does that do to the DXY, which is very important for us?
Sure. It is our view that even though we expect more rate hikes from the Fed, we believe long-term interest rates have already peaked. Levels above 4% for both 10-year and 30-year Treasury yields that we got last year, we do not think will be revisited. Another way of thinking about this is that the more the Fed has to hike now, the greater the risk or the greater the possibility of the U.S. economy going into a deeper slowdown later in the year, combined with already declining inflation. And that is really driving our view of longer-term rates staying low and keeping the yield curve inverted. As for the dollar, similar to long-term interest rates, we do believe the dollar peaked last year. We saw very significant dollar depreciation in Q4 of last year. We're going through a consolidation phase right now as people reprice the Fed. But I do believe that over the course of the year, especially as we see better growth out of parts of emerging markets, that foreign currencies will continue to appreciate against the dollar.
Appreciate against the dollar. Well, that will be a bit of relief in India as well. But Kaushik, what's your sense? The dollar index, DXY, went all the way down almost 2 digits. It was 100 something. And then it's now come back to 104 plus. So does this rally, are we almost at the end of this rally, or do you think it can go towards 110?
No, I don't think that DXY again heads towards 110, at least near term. I think our expectation is that obviously what we got was some surprise on the CPI front, a sort of retracement of that inflationary trend that we had seen for a few months now.
Yes.
We've seen obviously looser financial conditions. We've seen second round inflation. Food price has been a big sort of story around the world. All of these cause sort of inflation to tick up a little bit and market to reassess the potential for that path lower on the inflation front. But also I think equally Fed speak has clearly been highlighting that the need to do more and sort of stay on that inflation story for the time being. So I think we've seen both those things. Market was expecting some sort of a very slow trajectory on the inflation front, gradually going lower, having averted recession. At least that was market expectations. I think the soft landing trade was clearly on in full swing, right?
Yes.
And that's
January we have seen it play.
Absolutely. And I think we've seen a little bit of retracement to that. So combination of CPI, combination of Fed talk, as well as sort of retracement in the sort of risk assets, all of which has caused DXY to sort of tick up a little bit. And I think, near term, we could have a little bit more room to go. But again, I don't necessarily think it has that strength to go significantly higher from here. I think more or less, we are at the end of that rate hiking cycle, as Eric said. The market is now, almost fully pricing in those 2 rate hikes. There's a possibility that the Fed has to do 1 more. Our house view is 2. But I think given that sort of a scenario, we are well within the range of expectations. So I don't necessarily think DXY needs to go significantly higher from here.
So what does that do to the rupee in that case? You said some appreciation. Late last year and early this year, people were even expecting 79 on the rupee. Do you think that much of appreciation is possible?
I think that's a little bit more than we would expect. There are a handful of factors that I think will keep rupee relatively stable this year, even with a relatively good growth environment. As we all know, the MPC is hiking rates and in our view has one more hike to do. There's the risk of higher oil prices, which as we know plays on the fiscal balances for the country and the economy. And there's also the issue of rebuilding FX reserves. And so I think during periods of dollar weakness, when the INR could appreciate, you will see more forceful dollar accumulation and FX reserve rebuilding. So I think it will keep the currency relatively stable, which, by the way, isn't such a bad thing.
No, stability is better. So you would put it at what, 81?
I would put a range of 81 to 83 for the rest of the year.
Okay, we've been there, done that. Kaushik, what's your expectation in terms of the Indian yields? We had a nasty inflation number the last time, 6.52. We weren't prepared for that. We thought we had seen the last of 6%, but now it looks like it's going to stay higher for longer here as well. So will Indian bond yields also rise more?
So I think it's been trading in a sort of fairly tight range over the last few months. I'd say 720 to sort of 750-ish range. I don't see it break out of that range near term. I think this inflation number was clearly a bit of a surprise. Obviously now the market is fully expecting that rate hike later this year. I would say once we get past that, and I think we start seeing inflation actually trend lower, it probably sets the stage for investing in that IGB space in a much more structural manner.
Even without India being included in the bond index?
Yeah, I think the bond index is not probably going to happen over the near term. I think things need to happen for that to sort of play out. But I think people will be looking for opportunities in markets that are obviously attractive from a yield standpoint. Okay. Nominal yields are attractive. I think real yields have to adjust, right? I mean, so when inflation starts to go lower, real yields automatically start becoming a lot more attractive. And I think perhaps Q2 is the time when people will start looking at this market more closely.
Q2 calendar?
Yeah, calendar year.
Okay. Yeah, I mean, the expectation is that inflation goes to 5 at that time. And then, yes, then there is a real, over 2 percentage point advantage. Right. I take your point. But people have written off inclusion in the bond index altogether. In policy circles, now and then there is an expectation that it is revisited in March, isn't it? The JPM bond index. Yeah. But people outside aren't giving much of a chance.
No, I think people do get excited every time they hear that, and I think they do hope for the bond market to get included in the index. I think it'll be a very significant portion of the index. Along with Indonesia and China, it'll be 10% of the index. So I think it'll be a very weighty component. People can't choose to ignore it at that point. Yeah. So I think it is something that people look forward to. But I think on a standalone basis, the market has a lot of merits. And I think it's one of the more liquid local currency debt markets in the world. So I think even without that index inclusion, from time to time, people will invest very heavily into the market.
Okay. Oh, there is headroom. Yeah. I think India allows 6% of total outstanding bonds to be bought by foreigners. And I think at the moment it stands at 2%. I could be wrong by a few decimal percentage points. But there is a lot of headroom. So, okay, second quarter, the government will embrace it with both hands because the borrowing program starts in April. Eric, I want to ask you about the China factor. First, what does it do to inflation? Is the growth likely to be inflationary?
We don't think so. And this is something that's generating quite a bit of debate and discussion in the marketplace with China's about face on zero COVID and the sudden reopening. There's what appears to be a surge in demand. But we would also propose that there's still significant excess capacity in China's economy. There is a significant inventory of unsold homes. There is very high levels of youth unemployment. And so even though we do expect a material recovery in growth, it's going to take quite a bit of time to work through that excess capacity. And don't forget that as China reopens, the supply chains that originate out of China will start to function better, and that should be disinflationary for the global economy.
Okay. Well, I was told that as a house, you all don't take too much interest in equities, but do you expect the current risk rally? Okay, already as Kunal said, as Kaushik said, it's been sold into. But do you think that this risk rally has legs? People seem to be believing that the US and the world economy can escape with a very light recession.
So we've written over the last few weeks that we've turned a bit more cautious on risky assets. And the reason for that is the renewed increase in US interest rates, renewed anxiety about the Federal Reserve and how much more they might have to tighten. And as Kaushik and I have both been saying, credit spreads and spreads in risky asset securities in general have narrowed dramatically. And we think that overstates the improvement in the outlook for these assets. So we're cautious here. We expect a period of consolidation, maybe some retracement. We think people need to reduce their risk a little bit over the course of the next few weeks.
Okay, but is this risk aversion likely to only impact the developed market or US equities? No, any view at all on Indian
I think it's global.
Equities?
I think it's global. It's developed and emerging markets. Because don't forget, when we get these periods of risk aversion, when we get these periods of dollar strength, that has a real impact on emerging economy assets. And part of that is the transmission effect, right? Part of it is the tightening of financial conditions from the US back to emerging economies. So I think EM assets should struggle a little bit in the short term as well.
Okay, that's a very important clarion message coming from the Stand Chart team. Kaushik and Eric, thank you very much for dropping by in our studio. I think that those are very important takeaways, that the risk rally that we saw since Jan, already appearing to find some resistance, can see some more takeoff from the table, that even EM risk assets, including India, can struggle, but on the currency, expect stability 81 to 83. That's it on this edition of It's the Economy. Back to you, Chartbusters up next.